Hey, it's Stuart. I get asked quite often, what do I do if it's not worthwhile paying for financial advice? I wrote a blog last year and recorded a podcast episode about, working out, is it worthwhile paying for you to pay for financial advice? Given that most really good financial advisors these days charge around about $5,000 a year. And so how do you work out whether you're going to get $5,000 or more than $5,000 worth of value? And it tends to come down to, how much assets do you have in terms of investment, super, all these sorts of things to manage, as well as, or in addition to, how much cash flow do you have to invest each year? And if you've got a lot of each, or either of those two things, typically it's worthwhile paying for advice. If you don't have a lot of either of those two things, then it's probably not. So for instance, if you've got $10,000 to invest each year and it's going to cost you $5,000 for financial advice, probably not worth you paying for a financial advice because the cost is going to outweigh the benefits, even if the advice is fantastic, of course. So in that scenario, what do you do? How do you navigate these financial decisions, knowing that making the right smart decisions, has huge compounding benefits? Well, I think you can categorize financial decisions into sort of two categories, if you like: straightforward financial decisions and complex ones. Straightforward financial decisions are those that if you have the fundamental understanding of investment fundamentals, that you should be able to come up with an answer to. That is, that there's one clear best answer in terms of what is your next investment, or what is your priority in these sorts of things. Let me explain using an example. We know that investment grade property, its main attraction is its compounding capital growth. Any asset that gives you 7.2% on average growth over a long period of time, it means the asset's value doubles every 10 years. So if you buy $1 million property today, in 10 years' time it's worth $2 million, in 20 years' time it's worth $4 million, and in 30 years' time it's worth $8 million. That's $7 million of equity over a 30-year period. Sure, it's a long period of time, but really it is the easiest way to generate $7 million over that period of time. It's compounding capital growth. So that's the fundamental understanding of investing. It's not my opinion, it's just basic maths. And so then if I'm approached by someone in their 20s or early 30s that, has a good strong cash flow, maybe a little bit of cash savings in the bank, maybe they own some shares or crypto typically these days, have a small super balance, wondering what their next move is. Clearly it's go off and borrow to buy an investment grade property, the highest quality asset that you can afford it within your budget. And the reason I say that is just because of compounding capital growth, and it really is that next best move. That's what I call a straightforward financial decision, because that's the one obvious answer, and any other alternates like make additional super contributions or regular share market investments, typically for most people are inferior options, far inferior options. But of course, sometimes there's complex financial decisions, and complex financial decisions typically arise when there's lots of different alternative options. So maybe you're someone that is more financially established, that has a very small home loan or maybe no home loan, couple of investment properties, a share portfolio, healthy super balances, and they've got a really strong surplus investable cash flow each year. What do? Do they buy another investment property? Do they make additional super contributions? Do they keep investing in shares? There's so many options that you really need to sit down and do the numbers. In that situation, when you have a complex financial decision, often it's worth paying for financial advice. So my advice then to people is continue to apply an approach, which I'm going to talk about in a second, to navigate straightforward financial decisions until you get to a complex one. And then when you're faced with the complex one, that's when it's probably worth paying for financial advice. So how do you navigate straightforward financial decisions? Well, the first thing is you need to upskill yourself. You need to have an understanding of the core fundamentals of investing, which frankly tend to be rooted in just basic logic and maths, so should be relatively easy to understand, but you need to understand them. It's all the things that I really focus on talking about in my podcast on this YouTube channel. but it's really things like the power of compounding capital growth, what makes a property investment grade, that if we're going to invest in the share market, that all the stats, all the data tells us that picking stocks or using active fund managers typically doesn't produce better long-term returns, and that using a rules-based approach such as indexing that's low cost tends to produce much better longer-term returns. That investing in super, to maximize returns and minimize fees is paramount. These are the sorts of fundamentals I talk about a lot that you need to have a grasp of. Once you've grasped those fundamentals, it should be relatively easy to work out, if you are faced with a straightforward financial decision, what the best answer is by applying those fundamentals. And it's the reason that I wrote the book Investopoly. I wanted to write about the 8 rules that I use in my day-to-day work to navigate those sorts of straightforward financial decisions and work out, in fact, first and foremost, whether it is a straightforward financial decision or whether it's a complex one. So once you've understood the financials, you then need to find yourself a mentor. Now that mentor could be a friend or family or colleague, but I reckon the best mentors tend to be professionals that might already be working for you or could work for you. So that's typically an accountant or mortgage broker. Now, I'm not saying you should go and take advice off someone that's not licensed to give you advice. What I'm saying is that there's mortgage brokers and accountants out there that are already in the process or have built personal wealth themselves. They've navigated the same decisions that you're navigating, and they've done 2 things. They've worked out what the right answer is, and they've got a lot more experience in working out the right answer is than you do. And they've built a network around themselves, a network of other trusted professionals that you can lean upon. And my idea then is, if you can find somebody like that to be your sort of mentor, when you're faced with a straightforward financial decision, and you're not going to be on the phone to them every week, but there might be only 1 to 3 decisions you might need to make every 12 months, you run it past them. Does this sound right? Is this the right approach? Is there anyone else I should speak to? And they can, first and foremost, if you're making a glaringly obvious mistake, they can point it out and save you from making that costly mistake. But if you need additional help, they might have someone that they know and trust that they could refer you to that's going to help you with that decision. It really just creates some guardrails around navigating these straightforward financial decisions. So how do you find a mentor? That's a challenging one. I would say most people that are going to be suitable for this situation are people that get a kick out of helping their clients. And so quite often people like that tend to produce content exactly like this, just because they get a kick out of sharing it. So if you find people online a little bit like that are openly sharing content without any sales pitch, they tend to be a good example. Or to find anyone that has a high level of trust, a referral tends to be the best way. So ask around, speak to people that already have built wealth. Who are they using? Who might be suitable? Who's open to doing that? And keep asking around and keep networking until you find the right person. Now, when will this approach not work? Well, of course, if it's a complex financial decision, you shouldn't cut corners. And if it's, and you shouldn't be taking any guesses. And if you do have a bit of complexity in your situation, probably is worthwhile paying for ongoing financial advice. Also, if you don't really grasp the fundamentals that easily, for some people it's really natural, and they have a natural sort of understanding of money and finances and investing. And after listening to a few podcasts and reading some books, they get a good grasp of it. These are the sorts of people I'm talking to, but equally there's other people out there that just, it's all foreign to them. It never really resonates and it's still really confusing. In that situation, even if their position is quite simplistic, it's probably worthwhile paying for financial advice if you're in that situation. So they're the 2 situations where it's not going to work necessarily that well. Now, I try and keep this channel and my podcast, very sales pitch free. I don't talk about my business or my firm or anything like that. And I would like to keep it that way. But what I'd like to do is share a couple of stories. And this is how the idea of this video came up, in fact. A couple of stories of some clients that we've worked with, one that's been new and one that we've worked with for some period of time. There's a client that approached us a couple of years ago. He knew he wanted to buy a couple of investment properties, didn't know really where to start. We sat down and understood his capacity and talked him through, where markets are at different cycles. And we decided to buy a property in Brisbane, an investment property in Brisbane. That was his first port of call. Obviously set up the loans and then referred him to a great buyer's agent. And he ended up buying in mid-23 for $1.1 million. Now, we've only just recently revalued that property. That valuation's come in at 1.4, so about 300,000 of growth over that time, and the property's yielding about 4%, so it's a really strong asset. Now we're using that equity that he's got in that Brisbane property to buy in Melbourne, which is kind of his next best point of call, and that Melbourne market's ready to kick off. It's really improved this year. So I think we'll get the timing right there for this client. And so the benefit there is we're independent. We don't really care where he invests. We just think about what we would do if we were in his shoes. And we've referred him to two great buyers agents. That goes a long way to achieving great results. That is buying a really good quality asset. Another example is a client we've been working with for about the past 16 years. And about 10 years ago, in around 2015, we talked to him about buying his forever home. So he wasn't ready to move into that home, but in the school zone that he wanted to send his kids to school, in the area that he really wanted to live. And it was a real push, both from a cash flow and borrowing capacity perspective, and certainly over the last few years when interest rates have been a bit higher, it's been challenging. But if we hadn't have done it back in 2015, and the client lives in Perth, if we haven't done it and did it in 2015, it wouldn't be affordable today. So in 2015, he purchased the property for a 1.2. Today, that property is worth north of $2.5 million. So, $1.3 million of growth over that period of time. But the point is, it wouldn't be affordable today if we didn't do it back then. So interestingly enough, he's about to move into that property, and that's about to become his principal place of residence because he's been renting it and using negative gearing to sort of help with the affordability of that asset. But that one really important decision is not only put him in a really strong financial position, but there's huge lifestyle implications as well. Of course, being able to send his kids to a great school and being able to live in a great location. So anyway, I wanted to record this video because, as I said, I get asked all the time, well, if we can't afford to pay for advice, what should we do? And really, that's my approach. If you're looking at straightforward financial decisions, you should be able to learn the fundamentals and work it out yourself. Run it past a mentor just to make sure you're not making any silly mistakes or there aren't any other things that you haven't thought of, and use that relationship and more particularly, lean on their network of really great professionals to help you navigate those straightforward decisions until such time when maybe you're confronted with a complex decision, in which case then maybe you've got to go out and pay for advice, or maybe you can navigate your whole life through straightforward financial decisions. Anyway, I hope that's been useful. Of course, we'll include the detailed blog, the link to the detailed blog in the description of the video, and I hope that's been useful. Cheers.